Well, thank you very much, Adam, for that. And just welcome to our private equity session now. We've got a fantastic lineup of panelists for you today. Some great expertise up here on the panel, but I know that you're all experts in this field as well, so please make sure if you have any questions or comments about things that are being said, please do stick your hand up. We have people standing by with microphones to help you ask your questions. So please do jump in as and when. Our panelists, we have on the far end, Mark Sawyer, who's a senior partner at Greenstone Resources. We have next to him, David Street, a principal at Tembo Capital. We have Ross Bapu, who's a partner and head of private equity funds at Resource Capital Partners, based in Denver, I think. Yes, thank you very much for coming all the way over. And Pim Kalisvart, who is portfolio manager at Hawke's Point Capital, out of a very nice office down in, what is it, sort of Sloane Square. Yeah, very, 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 very nice area. Anyway, thank you very much for making all the way over here to the city from your delightful office over in Sloane Square. Gentlemen, welcome. So, going to keep this sort of, start off fairly sort of general discussion. Your views on the market, how's it looking from a private equity point of view? Mark, do you want to kick us off down there?
No, sure. Well, I guess David and I were just talking about this actually just outside this room about where we are in the cycle, and obviously a lot of the talk around the conference and around the city is that the cycle has turned, things are getting better, and I think we would obviously agree with that in terms of commodity pricing, and you've certainly seen more appetite from traditional long-only funds to invest in the sector. But I guess from the type of investment opportunities that we're looking for, which are very much focusing on pre-production companies, typically with one, maybe two projects in the pipeline, we haven't seen that re-rating in the sector yet. So there's clearly, the likes of BHP, Rio, mid-tier have re-rated, and there's been a lot more interest in exploration companies as well. That's typically from the retail. It's not large sums of capital, and it's driven by day traders and the like. But in pre-production companies, we're still seeing a massive amount of opportunities, and I would probably say that the pipeline is as healthy as it's been at any time over the last 3 or 4 years.
So saying that although commodity prices have risen, the equities are not keeping up?
Yeah, no, I think so. I think it's a question that there's a commodity cycle, but there's also a cycle in equity capital markets. And at risk of being a bit flippant, I don't think greed has overtaken fear yet from that perspective. And I think there are projects that are getting away and raising money from the long-only funds. But I mean, we've seen a couple of investments in our portfolio where we've followed our rights as part of a construction fundraising. There's been a significant slug of capital that have come from so-called blue chip long-only funds, only to see those funds then sell down within a matter of a couple of weeks, which is obviously very, very unhelpful for the company itself. That's then trading into a pretty strong headwind. So look, I think you are seeing a return of appetite, but it's very, very selective, and in our view is going to take a few years before it returns to sort of previous strength. The infrastructure isn't there. A lot of the specialist fund managers have gone away. You're seeing a lot of generalist funds playing the space who typically hold 2, 3, 4 maximum investments rather than a portfolio of 50 or 60. So it will come back. It's just early days, I think.
And you said how many projects are you currently owning?
Well, I think we're in 10, I think, 9 or 10.
And how many are you looking to? What would be your sort of maximum number, your ideal number?
Well, I think it's constrained by fund size, but I suspect we'll probably do another 7 to 10 investments in this current fund, and then look to raise a third fund.
Is there a limit, though? I mean, for a private equity fund, obviously part of your rationale is to be able to add value to those companies using your expertise. There must be a sort of an upper point at which you're too thinly spread between these projects.
Yeah, look, I think that's a very good question. And we typically don't look to take control or a controlling interest in any of the companies that we invest in. So, morally and legally, we're not running wholly owned subsidiaries or majority owned subsidiaries, so we are able to spread ourselves across a broader portfolio of investments. It comes down to doing due diligence on the management team that you're backing, because whilst the geology's got to be right, the country's got to be right, and all the other conditions that go to driving a good investment, a good project have to be there. At the end of the day, you're backing a management team. So even those management teams that are incomplete, they still have to have that sort of core skill set to actually develop the underlying projects.
And any commodities you're particularly keen on at the moment and looking forward to 2018, you see there's going to be opportunities?
Look, I probably sound like a stuck record on this one. We're sticking to our knitting, and our focus remains exactly the same as it did 3 or 4 years ago, which is base and precious metals. I know lithium is talk of the town. It's not a commodity I particularly understand, and I tend to, therefore steer away from commodities I don't really understand.
Absolutely. David, your thoughts on how the market's looking, and Tembo, you've just finished raising a fund that was successful.
Yeah, that's right. We raised a second fund, and we closed that off quite recently. Quite similar to Mark, actually, in many respects. We've got 10 current investments. We may well make another one before the year end, but we're looking at about sort of 14, something like that, across the two funds, 14, maybe 15. And we're looking to take sort of strategic positions in companies with a shareholding of 10 to 30, 40%, that kind of thing. And then we add some value, as you talked about recently, possibly with a board seat, but also some strategic sort of assistance to companies. I think the market clearly has come a long way this year. There's a lot more retail appetite around for companies. The battery sort of theme is very strong. I do think next year could be a pretty interesting time in the market, but it's a very, very patchy market, I think, for companies that are trying to raise significant amounts of money to advance projects. Still not an easy thing to do, particularly in precious metals, actually, and in some of the base metals. So I think there's a lot of opportunities for us out there. We've got a strong pipeline, but I think next year will actually be a good year in the market.
Which types of companies are actually able to raise money at the moment, are you finding?
I think it's a patchy thing depending on management teams, commodities, particular types of asset and location of the asset, and some things are sort of hot, and you'll have seen themes where a particular company's done well and one or two other sort of look-alike companies then follow on and are able to raise money, but it's not an across-the-board recovery at the moment, certainly. It's quite a patchy sort of thing.
Right. And why do you think, you mentioned the precious metals side, that's been quite difficult to raise money. Why do you think that is still?
I think precious metals had a good run as we came out of the very grim sort of downturn period of a couple of years ago. That was the first sort of commodity to come out of them at that point in the market. But I think this year it's kind of stagnated, and a lot of investor interest has gone into battery materials and some of the base metals as well, and other things, actually, to be honest. And I think potentially the ETF sort of market has taken a bit of the froth out of some of the junior precious metals markets. For that reason, although you generally can raise money, relatively readily for precious metals companies, I think they're possibly looking a bit undervalued relative to some of the other things around at the moment.
And that's obviously creating opportunities for you guys.
Yeah, I think so. There's companies that have sensible projects that need a decent amount of money to advance them. Yeah.
I mean, we mentioned earlier in the panel and this morning there was some talk about Bitcoin and the impact that has on the retail investment into gold projects, because the sort of people who don't like fiat currencies, don't like paper currencies, and invest in gold would now also look at Bitcoin as a similar vehicle for investment. If Bitcoin, given that it is now over 9,000 and there's all these ICOs raising vast sums of money on fairly flimsy sort of white papers, is there an opportunity, do you think, a possibility that will have a little pop in that bubble, collapse that bubble, and that will drive people back into the gold space?
I mean, that's a tricky question. I'm not really the best person to ask around Bitcoins, but I know some of the Canadian shells that have been launched in recent months have done phenomenally well on things like Bitcoin, and they're very well marketed stories. Does that come back? Maybe it comes back. I think the ETF side of things as well as also on a longer term basis is more challenging for precious metals probably. I think it likely comes back, and maybe there's an opportunity at some point. But in any market, you'll always find some people who think gold's going to $5,000 an ounce. You know, as long as I've been in the industry, you've had people saying that. So,
are they still saying that? Because they have been saying that for donkey's years now, and silver as well is going to.
There's still people around say that. Yeah.
Yeah.
I'm not sure how many of them are in the audience, but but there's always people who.
They're a
have
bit
that
quieter
view.
these days, though, because I mean, over the years, we've had people at the conferences who are constantly like, it's going to 10,000, it's going to whatever, and hasn't yet. So, anyway, come on to that maybe later. Ross, tell us a little bit about what you're up to at Resource Capital Funds.
Well, we're just finishing investing our 6th fund and have just started investing our 7th fund. We really, we operate across the spectrum. So we've invested in 30 different commodities, sort of blotted across the periodic table. Today, we're interested in base metals. We like precious metals, but we also really like the minor metals, some of the metals that are off the beaten track, so to speak. I think we're seeing value sort of across the board, notwithstanding the fact that commodity prices have moved up a bit. We're still seeing pretty strong value in the metal sector across the board. So,
some of those metals off the beaten track you mentioned. What sort of things?
Oh, look, we like cobalt's not off the beaten track, but we like
Anymore.
cobalt, we like zinc, we like copper, we like nickel. We're a little nervous about lithium. We were very large investors in lithium previously, but we've gotten out of that. But some of the minor metals are still very, fairly interesting to us.
Why are you nervous about lithium?
Look, there's a lot of lithium out there, a lot of lithium projects on the drawing board. So we're sort of standing on the sidelines now that we've been in lithium. We were the world's largest producer of lithium at one time, and now we're just sort of sitting back watching what happens here.
Are those new projects that are on the drawing boards, are they able to find funding though? I think there's a question about whether banks will lend to them.
Yeah, it's a good question. I think it's going to be tough for some of these smaller ones. The ones that are existing looking to expand operations, I think there will be funding for those groups, but some of the green projects, the greenfield projects, I think they're going to struggle to raise funding.
But isn't that therefore going to keep supply out of the market? So we've got maybe a slightly longer run than people.
Groups like SQM can raise capacity very, very quickly and quite extensively. So, again, we're sort of nervous about the potential for large new supplies to come on stream there.
Are you looking at some of the processing techniques coming through as well? I mean, people like POSCO are saying that they can reduce the time from evaporation of the salars from 18 months to a few days or whatever.
Yeah, we tend to shy away from new technologies until they're really proven. When we can see them in operation, when we can go touch them, feel them, see them actually operating, until they get to that stage, we sort of shy away from new technologies in that regard.
Right. Resource Capital Funds obviously is quite well known for supporting companies at the earlier stage. I mean, throughout the life cycle really, but at the earlier stage. What's your take on the exploration sector right now and the opportunities there?
Yeah, look, I think it's fantastic. The retail sector we think has dried up quite a bit. There's, our focus really within the PE fund of Resource Capital is later stage, so post pre-feasibility through construction and into operations. But we do have an allocation within our funds to fund those early stage investments, and we've actually allocated a large chunk of money to exploration, and it's finding some great home for that money that that we haven't seen in a long time. The exploration dollars from the majors, from the the Newmonts, the Barricks of the world, have really sort of dried up, and so to help fund some of those management teams, I think is quite quite attractive in a lot of ways.
And are you looking for opportunities? I mean, obviously we talk a lot about the need for the majors to replace their resources. Is this going to be, going forward, is this going to create lots of opportunities for potential M&A in the exploration end of town?
Yeah, we certainly think so. When we look back to what we went through in the early 2000s, tremendous M&A opportunities back then, I think that's going to come back, and we'll see that again here in the not too distant future.
in the not too distant future being when?
Oh,
Predictions?
2 to 3 years.
2 to 3 years.
Yeah.
Okay. Excellent. Pim, tell us a little bit about what you've been up to recently at Hawke's Point, and what's your view on how 2018 is looking?
So, it echoes very much what the other panelists have said. I think, to pick up on, in part, your Bitcoin point and what was mentioned earlier by particularly David and Mark, we still see enthusiasm and buy-in from retail investors and maybe some of the long-only funds. But as quickly as they come in, they also leave, and that capital doesn't necessarily go towards construction. We still see a massive opportunity for funds like us who have a much longer-term vision to assist companies raising their construction finance. So although we see some ends of the market being frothy or getting a lot of support, it then can drop up equally quickly, and sometimes it's pure on the basis of people taking profits or sentiment. I mean, we've seen huge volatility in the conglomerate story that's come up overnight and seems to drop off like a stone now too. So against that backdrop, good projects with solid management teams still need those deep-pocketed investors, and I think some of us on the panel, or all of us, in fact, would classify ourselves as ideally suited for that, and our pipeline, like I'm sure everyone else's, is as good as it's been. Particularly focus on commodity continues to be the base and the precious metals, but we'll venture a little bit further. I think where we have challenges in maybe minor metals or those non-exchange traded commodities is seeing a way not only for us to add value because maybe we don't understand them very well, but also how do we eventually exit an investment like this. Things might turn overnight and you might get lucky, and a lithium situation might eventually come about in a graphite or such, but in the absence of that, it's very difficult to see how, to pick up on your last point that you discussed with Ross, how a major would want to buy your project. Whereas if you have a precious metals or a base metals project, if it is a good solid project, there is an option. It's not the base strategy, but there's a solid option that a major might take it out from you, or there'll be solid investment interest. With some of these other minor metals, that's a lot more difficult to convince yourself of. And that in itself poses a risk that, at least at this stage, I don't think we're comfortable taking.
But if you're going for projects which are, obviously good management team, you'll mention, but a good asset in a commodity with a, decent outlook, a price outlook, aren't those projects already sort of finding funding? Doesn't that sort of shorten, lessen the number of projects that you might find good value in? If you see what I mean. So are you possibly missing out on opportunities for acquiring low-cost projects?
I think the opportunity to buy rock-bottom prices, fantastic, much-abused term, world-class projects, that might have been 4 or 5 years ago. I think you need to look through a slightly different prism, and there's certainly still misallocations of value, maybe not to the tune that it was when gold was at 1,100, but certainly even at this price, non-funded projects still trade at a big discount to theoretical value, and it's simply because in the retail market, if it doesn't see an ability for that project to actually fund its construction, it will leave the stock as unloved as it loves the projects that seem to have a sparkle. But like I said, the example of the conglomerates is a good one, and you can see how quickly things can get priced up and again come down when people don't like what they see.
Which sector of the market do you think is most undervalued at the moment? And anyone could take this possibly.
Pre-production sector. Yeah.
And is that across the board, across the commodities? If you were looking for the best value opportunity, what would you go for?
Be a good starting
Theoretical
point.
project.
Be a good starting point. Yeah.
Just anything pre-production.
Yeah. More so, intuitively more so than a producing asset. There's exceptions to every rule. But if someone is producing cash flow today profitably, and you can price that against a cash flow multiple or so such. I think the market understands that better, and long only funds, etc., have a better sense of value there and price it accordingly, much more so than what we see in pre-production companies.
Any thoughts on geographies and locations of projects where there are opportunities at the moment? Ross, do you want to thoughts on that?
Yeah, look, we've been very active in South America. We see some great opportunities there with some of the privately owned companies. Chile, Peru have always been sort of high-priced areas, but we're finding great opportunities with some of the privately owned businesses there. Look, parts of Africa we're very active in, although we're very cautious about geopolitical risks there, but there's some great undervalued areas there. So no, we're very global. And
any thoughts on obviously Tanzania had some issues earlier, but probably seem to be solving that. Zimbabwe possibly opening up again.
Probably staying away from some of those areas for right now. Let those settle down a bit. But there's other areas, Botswana, Ghana, Guinea, that we feel pretty good about.
Absolutely. Let's talk a little bit about sort of competition for money. If I'm a big pension fund and I'm thinking where to allocate my money, why do I put it into a private equity fund rather than putting it into JP Morgan or BlackRock or something like that?
Well, I don't think, first and foremost, I don't think they're mutually exclusive. And I think these pension funds, the pool of capital is so large that actually putting money behind JP Morgan or any of the funds sitting up here today, you can do both. I think certainly talking to our investors, and I can only give you their perspective, is that so much money was lost in the last cycle through, I guess, people got a little bit exuberant at times, and I think a lot of these funds didn't do their due diligence on the assets or the companies they were putting money behind, and then surprise, surprise, when the music stopped, they were left with a huge mark-to-market loss. And I think the justification, because clearly the fee structure from a private equity perspective, it's a lot more expensive than putting money into a long-only fund or a hedge fund that will charge a fraction of the management fee, is what they're paying us for is to do far more thorough, for a number of reasons, but from the aspect of doing due diligence on the asset and getting the fundamentals right. I think that's why they're putting money into private equity. It's backing experience, it's backing a skill set and an understanding of the sector, and I'm sure everyone sitting up here today has got war stories from their past, and I think you learn from your mistakes, and we've all put money behind things that haven't worked out, and I think you take that experience going forward, and I think that's what our LPs certainly are looking for.
What's the greatest risk, though, to you? You put money into a project. What's the thing that goes wrong if it goes wrong?
Do you know, in my experience, it's never the geology, it's never the mining. It's not because their head grade proves to be slightly different or your mining cost proves to be slightly different. I think, all of those things obviously have a cost-value implication, but a lot of them can be managed. And if you do your due diligence up front and you build in sufficient headroom in your own underwriting assumptions, you normally can make it work. I think things go wrong either because you get the social side of things wrong, you lose your so-called social license to operate, or your relationship with the government, the assets taken away from you, which I think is probably an extreme example, but those ESG type issues can have a binary outcome. What you have is either worth what you think it's worth or zero. And probably the other issue is people. And I've said this before, sitting up here, it doesn't matter whether you're selling hot dogs in Hyde Park or trying to put a man on the moon. When things go wrong, it's because of people. So you can have the best project in the world, but if you've got the wrong team managing it, you can make some really expensive mistakes along the way. So I'd say people on the ESG side of things.
Is also having a depth in the management team important, rather than having sometimes you might have a company where there's one key guy.
No, I don't. No, I think you have to be realistic. I think that's absolutely right. But I think in a lot of pre-production companies that we look at, they haven't had the balance sheet or the luxury of cash flow necessarily to build the complete team. So yeah, you are looking for backing the core team of one or two guys or girls, whatever. But I'd say in the majority of cases, even those good management teams that we see, that we're prepared to back, are still incomplete. And as everyone in this room knows, that team grows as the project matures and you rapidly approach a construction decision. So it's as much as anything, not just understanding the team you're backing, but it's also making sure that they know what they don't know and appreciate the need to expand that team as they approach a construction decision. And that's a very nuanced decision because a lot of teams that we see often then become quite reluctant once they've got your money to start building overhead. And that's a constant, well, not constant, but it's often a point of tension between the investor and the management team. You've got to plan for success.
Ross, you have something to add?
Well, I was just going to say that one of the biggest issues for us has been capital cost overruns, where management teams just go in and push their engineering companies so hard that they fail to include everything in the capital cost. So, in lessons learned for us, absolutely having the right management team in place, but we're happy to be involved in enhancing those management teams, making sure they have the right people in place, and we do that in 95% of the projects we invest in. But at the end of the day, it's making sure that they're adequately funded when they go into construction, because that's where we've seen the biggest loss of value is when they have to go back to the market being 75% complete on construction and have to raise money under extreme duress. That's a major problem.
Yeah.
So I would just say technical understanding of the project, and we have about 45 people that on our team that do nothing but technical due diligence. So it's
Right.
a big area for us.
And I guess at the moment the costs of things are down. So are you finding that your projects are hitting their milestones and getting?
We're finding a much better success rate there, but it's again because we're doing a tremendous amount of due diligence and we're adequately funding them for cost overruns.
But if the market comes back, are we going to see the sort of cost inflation that we saw in the last cycle? Is that something you're worried about?
I would anticipate we will. I mean, I think we've seen costs come under a bit better control now that the market was down for a while.
It's something you're watching. Do we have any questions from our panel? Question here, Austin.
Mark, you mentioned when the music stops, and you spoke about the human element of projects. But I think that looking at projects, I don't think there's enough conservatism in metal prices going into feasibility studies, and there certainly hasn't been any insight from the projects that I've looked at of people looking at bankruptcy prediction. And this is what we can see from Banro, African Minerals, London Mining. Any comments on using bankruptcy prediction as a way to minimize risk and possibly just say, stop the music and just warehouse a project because it's not going to work?
That's a very good point. Obviously, and I would agree with you that a lot of the published feasibility studies that you see out there have ridiculous commodity price assumptions underpinning them with heroic NPVs and IRRs as a result. I mean, all I can say that our approach when we look at a project is we'll take management's underlying assumptions, both technical and macro, and make our own assessment as to what adjustments we should make, whether that be a time delay, because things always tend to take longer to develop than management teams tend to tell the market. Not always, there are exceptions to that. Things cost more. And similarly on the macro side, we will run our own and plug into the financial models our own macro assumptions. And we, to take I think you described bankruptcy scenario, we would also look at, once we've made all those technical adjustments, what is the commodity price deck that your back solve for what commodity price deck you need to get your money back, which is that sort of doomsday scenario, because it gives you then a real flavor for how robust a project is. Because if that bankruptcy price deck, if I can call it that, is only a marginal discount to the current forward curve, then clearly you don't have a project which necessarily is as robust as it should be. So we'll definitely run all those different scenarios.
What sort of discount do you look for as a sort of comfort?
It depends on the commodity, but no, you don't run a standard discount. You work out what is the price that you need to plug in to get your money back, and then obviously the discount reveals itself. And if it's only 5-10%, that's not a big discount. If it's a lot bigger, then obviously you have a more robust project.
Yeah, sure.
So you can withstand the commodity cycle.
Unfortunately, we have actually run through that time just incredibly quickly there. Very interesting session. Just to finish off, dry powder. What have we got to play with going forward, Mark?
A significant amount. As I said to you before you started, I'm not going to tell you how much we've got left. We're at the beginning of Fund 2. We've got a significant amount to invest, and we're actively out there looking for new projects.
Fantastic. David, you just raised a fund.
Good to do another 3 or 4 deals of the typical sort of size, $5, $10, $20 million kind of level.
And you'll plan to do that over the next year or two? Or?
Next 12 months, probably.
Next 12 months, fantastic. Ross, you just raised some more
We're
money?
making investments from, call it, $5 million to $250 million, and we've got room to look at a number of different projects.
Fantastic. And Pim?
So we're investing out of the balance sheet of our parent. There's currently $500 million of cash sitting, burning a hole. So, pick a number, but we'll continue to be optimistic. If we do our job well, then there's plenty of room for growth.
Fantastic. So they've got plenty of money there. So if you've got a project that you think these guys can help you with, please do grab them afterwards. But thank you very much for our panel. Thanks.